So hi, good evening everyone. So I'm Lee Chai. So I'm a financial market analyst from Beyond Insights. So today's topic will be 2023 market outlook in layman's terms. So this session is specially arranged to be inclusive of people that are new to the financial market or stock market. So don't worry about all the jargons you heard out there, the financial jargons you heard out there, because throughout the sessions, whenever I explain about the financial term or the financial jargons, I will use as many layman terms as possible to keep it simple. And I also hope that you can participate as much as you can. So whenever I pose a question, I hope that I will get a response from you. And I also hope that you can participate throughout. So because this session is for you. And the stock market is dynamic. So whatever we share today is based on the current market data and also facts. So if there are further development in the future, so things may change. So do you agree? You may type in the chat, things may change in the future if there are changes in the economy situation. Okay, so you may heard of the news about the inflation, the news about central bank are raising interest rate, the news about recession is coming, and the news about the stock market is crashing. And often, all these news come together with all the financial jargons. So how many of you have this difficulty or problem that where you find it, the financial terms or the jargons are difficult to understand? You may type in the chat. Yeah, so only one. Okay, it's okay. So it's quite common that when you are new, you are difficult to understand all this financial jargon, and also it's also normal if you are new, you find it difficult to put all these news together to give you a clearer picture of the market outlook. So don't worry about that, because in this session, I'm going to provide you a market update on what's going on in the current market in layman term, and also at the same time, I will provide you on what is the potential opportunity ahead in 2023 and what are the potential risks in 2023. So let's get started. No sound. Terence, can you guys still hear me?
Yes, I can. All
okay.
good.
Okay, sure. Okay, let me continue. So let's get started. So the objective of this session is, number one, to update you on the latest factors that are affecting the stock market. So what is happening in the current stock market and what are the factors that are affecting the current stock market? And number two will be identify the main opportunities in 2023 and what are the risks ahead in 2023 as well. And number three will be how to prepare ahead for 2023. What are the best suited trading style and what are the best suited strategies? So for this portion, we have a systematic way that covered a different style of trading style, like for example, investing, swing trading, trend trading, and so on. It even include intraday trading for advanced students. But for this portion, it will be covered by Terence later on. So let's take a look on the factors that are affecting the stock market currently. So number one, we have high inflation. So before we go into the high inflation factor and the reason that causing the high inflation, let's take a look on what is inflation. So what is inflation? So let me use the whiteboard. So what is inflation? So what is inflation? So in layman terms, it usually refers to the rise in goods price. And it usually tracked in percentage term and in year-on-year basis. So what does this mean is if you see a news talking about inflation, let's say it says 5% inflation, it means that the goods price are 5% more expensive compared to the previous years. And it usually tracked in a basket of items. So for example, in the United States, usually we have the food and also the energy are one of the important items that it tracks for inflation. So let's move back to the slide and see what causing the high inflation. So what causes the high inflation? So anyone still remembers what happened in, so let me change my pen. So anyone still remember what happens in the Europe region during Q1 2022? So for some of you that know what happened in Europe during Q1 2022 that causing the high inflation, you may type in the chat. So what causes the high inflation? Anyone that knows this? Yes, we have a war in Europe. We have a war in Europe. So we have a war between Ukraine and Russia. So with this war, what is the impact to the world's market is it causes the commodities to go up. So it causes the oil price to went up. It causes the natural gas price to went up. And it also causes the wheat price to went up because Ukraine is one of the top wheat export in Europe. So based on here, we can categorize these commodities into two categories. So number one will be the energy, I mentioned earlier, the energy. And number two will be the food. So with the energy price increasing and also the food price increasing, then it causes to have inflation issue. And with the war prolonged, then we have it causes the high inflation issue. So these are the factors that causing high inflation throughout 2022 until this year. And it's getting higher and higher because the war was prolonged. And there is also other factors. And other than that, if let's say inflation never under control, what will be the problem? So we will have a affordability issue. If let's say inflation never went under control, then we will have affordability issue. Means that cost of living are going up. Things are getting more expensive. So in order to control the inflation, then the central bank need to increase the interest rate, which I will cover later. So remember, when inflation went up, then the affordability will come down because things are getting expensive. So the same amount of money, like $100, will be having lesser buying power. So next, let's move to the next. To control the inflation, then central bank will need to increase the interest rates. So before we go into detail of interest rate hikes, so let's go through a few jargons again. So let me go back to the whiteboard. So first term will be the central bank. Central bank. So what is central bank? So central bank usually refers to an authority that having these two roles. Number one, control the price stability. And number two, control the money supply. So what is meant by control price stability? Means control the goods price stability, means control the inflation. And what it means by money supply? So money supply refers to the money in circulation of an economy, in the economy of a specific country. So I repeat again. So money supply refers to the money in circulation of a specific economy in a country. So what are the examples of central bank? So for example, in Malaysia, we have Bank Negara Malaysia, BNM. Short form is BNM, Bank Negara Malaysia. And in Europe, we have the ECB, which called called European Central Bank. And in the US, we have the Federal Reserve, also known as the Fed. So these are the major central bank, or these are the central bank example in the world. And because we are from Malaysia, so Bank Negara Malaysia also is one of the important central bank to monitor. So in order to control the inflation, then the bank need to increase the interest rate. So before we go again, so let's explain about the interest rate. So what are the interest rate? Interest rates. So interest rates refer to the charges that the lender, so usually a lender, when they borrow money to the borrower, they will have a percent of charges. So for example, like our housing loan, we need to pay the bank interest rate. And for when we take up a car loan, then we need to pay the interest as well. So for all these interest rates is actually decided by the central bank. So what is the impact when central bank increasing the interest rate? So what is the impact when interest rate went up? So let me change to my pen. So what is the impact when interest rate? Sorry about my writing. So okay, what is happened? What's the impact when interest rate went up? So the cost of borrowing will went up. Cost of borrowings will went up. So what's the impact when cost of borrowings went up? So cost of borrowing went up means that it's more expensive to take up a loan now. So for example, so when cost of borrowing went up, businessmen are less likely to take up new loans to expand their business, or take up new loan to buy new equipment, or take up new loan to buy new buildings, because the interest rates are getting more higher. They need to pay more interest in order to take up the loan. And for end consumer like us, it's also less likely for us to take up new loans to buy new house, take up new loans to buy new car, or take up credits to buy new furniture for our home, or buy new appliances for our home, or buy ourselves new gadgets by taking credits. And this causes the demand to slow down. So we have a slowdown in demand, and people are less willing to spend. So spending also went down. So if demand is slowed down and spending also, people less willing to spend. So what are the impact to the companies? So anyone would like to answer in the chat? What would be the impact to the listed companies if the demand drop, slow down, or spending also become lesser? What's the impact? Okay, so it's okay. So what's the impact to the companies? Yes, correct. So what is the impact to the companies? So you will have the sales will have lesser sales, and also we have revenue drop. And this will causes the earnings to drop as well. This will cause the earnings to drop. And when companies' earnings drop, we have a lot of companies' earnings drop, then the stock market. So the impact will be the stock market will have a correction to the right valuation. So these are the factors that when interest rate hike, why the stock market will drop. So these are the chain effects of it. So when interest rates are going up, then cost of borrowing increase, and the demand will drop because people are less likely to expand their business, consumers are less likely to spend more money due to that. And with that, the side effect will be companies will start to have lesser sales and lesser revenues and having a lower earnings. And with lower earnings, it will cause overall stock market to have a correction to the right valuation. And other than that, the increase in interest rate will also affect the US dollars currency. If let's say the US central bank, the Fed, increase interest rate aggressively, then it will also affect the US dollars exchange rate. So remember when the interest rate went up, and interest rates go up, the exchange rate for, let's say US increase in interest rate aggressively, then the US dollars will went up as well. And this will affect the export of the country. So if an exchange rate is increased too strong, it will affect the export of the country. And it will also affect other countries that rely on the import of that country. So this is the relationship between interest rate and also the US dollars. And next will be, with the aggressive rate hike or interest rate increase, then it will increase the recession risk as well. Because if let's say the slowdown in demand is too fast, then it will cause a lot of companies not doing well and overall economy not doing well. And what is a recession? Recession is referred to the consecutive two quarter that having the economy having negative growth. So this will cause the recession. And remember, when people are seeing potential recession, and the stock market usually are 6 to 9 months ahead of the economy. So usually stock market will react 6 to 9 months ahead of the economy. So when people foresee the interest rate hike are aggressive and demand is start to slow down and companies starting to having lesser and lesser earnings, then people will foresee there will be potential recession and stock market will react ahead. This also caused the stock market to be in a correction mode since last year, 2022. So these are the factors that causing the inflation, the stock market to correct. So on top of that, we also have a supply chain constraint issue. This is mainly due to the COVID situation in China, and also in 2022, China are having very strict COVID policies. Means that they are having very strict lockdown and so on. And as we know, China is a world factory. They manufacture a lot of raw materials and also spare parts and also other electronics devices, and a lot of items export to the world from China. They build a lot in there and they have a lot of factories there. And with the tight lockdown policies, then it causes the supply issue. So we call it supply chain constraints, where we have not enough supply to all the demand that requires all these raw materials, these electronic devices, and so on. And this partly contributed to the high inflation as well. And next will be the geopolitical tension. So we have war in the Europe between Russia and Ukraine, and looks like it's not going to be end soon because both of them are still fighting and still under the war. So we foresee that it won't end so soon. So we may need to live with it. And also at the same time, in Asia, we have this US and China relationship tension between each other. So like tech war and a lot of sanctions going on, and also Taiwan as well, the Taiwan issue as well. So with all this geopolitical tension, it partly contributes to the inflation, and also at the same time, it also contributes uncertainty to the stock market as well. And to me, all this geopolitical tension not going to end in near term, so we may need to live with it as a trader or investor. We may need to live with it and mitigate the risk accordingly. So these are the 6 factors that are affecting the current stock market. Let's take a look into the detail of the data individually. So let's take a look on the inflation trend. So the global inflation trend. So these are the data we are tracking. And usually we track all these economy powerhouse. For example, like Europe region, the UK, and the US inflation status. And based on the current data, Europe is at around 11.5%, UK at 10.7%, and US at 7.1%. Although US are start to dropping, you can see the chart is coming down, but it's still at 7.1% high, which is still a high region. And you see this red line here, these are the central bank goals. So the central bank have a goal to bring down the inflation to 2%. So most of the central bank here are actually having the same goal, 2% inflation goal. So we are still at 7.1 to 11.5%. So do you think that it's easy for a central bank to bring an inflation from 10% down to 2%? Do you think it's easy to bring down the inflation? You may type in the chat, do you think it's easy or hard? Just type easy or hard in the chat. Yeah, it's hard. Huh? It's not easy. And we foresee that it may take more than 1 year. So there could be possibility we will expect more rate hike especially from the Europe and UK region, because their inflation are still going on an uptrend. And for the US, it also possible still have potential continuous of increase in interest rate. But I will tell you later on where are the potential peak there when I explain about the global interest rate. And also, with the prolonged inflation, and people are expecting more than 1 year to bring the inflation down, this causing the recession worldwide in Europe, UK, US not yet enter recession. I'll explain. I will show you the economic cycle later on, but it already causes recession in Europe and UK. And also, this not only affect the US economy, it will affect worldwide economy if this situation continue to go on. And these are the Malaysia inflation trend. So we are currently at around 4%. So our central bank, Bank Negara Malaysia, also targeting 2%. So we are expecting there is a potentially more rate hike to go in Malaysia, more rate hike to come in future in Malaysia, more cycle of rate hike, but it all depends on the government decision and also Bank Negara policy. And these are the inflation forecast from 2019 to 2024. So from the chart here, we are expecting the inflation to be stabilized near 2% in 2024. So based on the theory that I told you earlier, that stock market usually reacts 6 to 9 months ahead of the economy. So when do you think likely will be the stock market bottom? Based on the information here, you may type in the chat, just a guess. Based on the theory that we are expecting the inflation to be stabilizing in 2024 near 2%. And we know that one of the main root cause of the stock market correction is due to the high inflation, and the central bank need to increase the interest rate aggressively. So when do you think will be the stock market bottom? Around there, mid to end, yes. So if let's say 6 to 9 months ahead, so we are expecting somewhere here. But one important factor is we need to monitor the coming quarters inflation data and also central bank decision. So during this region, let's say Q1 and Q2, let's say we have quarter 1 and quarter 2 here. So the inflation data is very important, and also the central bank decision is very important. If let's say they come down as per forecast, then it will be a good news for the market, and we need to continue to monitor the data coming in from Q1 and Q2. And these are the World Food Price Index. So we can see that the World Food Price Index is also coming down, is stabilizing. So this further support the theory that the inflation started to come down because food price also coming down. But we need to monitor further to see the trend if continue to come down or stabilizing near some region. This will help the inflation if let's say the food price stabilizing and no longer in a steep climbing trend, in a steep uptrend. So hold on. So okay, these are the inflation. So next will be the interest rates. So let's take a look on the global interest rates data. So these are tracked by all the major central banks. So we have the US, China, UK, Europe, and also Japan. So the main focal point here will be US, UK, and Europe. And from the 2022 onwards, you can see that all the major central banks are actually increasing interest rate aggressively. They've been increasing interest rate aggressively. This is mainly due to the high inflation. And based on the rate hike cycle, on the last cycle, actually they are only increasing 0.5%. So this shows that potentially the interest rate could have peaked because they had started to slow down the interest rate hike. And partly the downtrend in the US inflation also contribute to this. However, we may still need to continue to monitor because the inflation in UK and Europe still going up. And also based on the latest FOMC meeting. So what is FOMC? So FOMC is a Federal Open Market Committee, which is a committee that, the Fed committee that having meeting 8 times a year to decide on the interest rate decision or the central bank decision. So based on the latest news, they foresee that the interest rate hike will likely to peak at around 5.1% region. And this tells us that currently US at 4.5%. So this tells us that there are potentially 0.6% to go around that region, 0.5 to 0.75% to go around that region. So this in fact will be a good time for you to start screening for stocks, because when interest rates are peaked, then the inflation under control, then the stock market will recover. So this in fact will be a very good time for you to learn about stock screening technique, how to find all these good stocks, and also how to prepare yourself to capitalize on the recovery later on. And next, we will look the data on the currency. So we are looking at the US dollars against ringgit. What is the trend? So as I mentioned earlier, during early cycle of rate hike, when US central bank are increasing interest rate aggressively, we can see that the ringgit was depreciate against the US dollars, and US dollars are strengthening. Strengthening means the exchange rate is getting higher. And towards the end of 2022, we can see that there is a spike here. There is a spike here. And what causes the spike? This mainly is due to the political uncertainty in Malaysia, because that time we have an election. So there are political uncertainty there. This causes the ringgit to further weaken against the dollars. And you can see that after the election, when things get to have clearer picture, stabilizing, the political situation stabilizing, then we can see that the ringgit has been strengthening against the US dollars. And plus the news just now that the interest rate hike could probably just 0.6% to go. We foresee that the US dollars will further weaken to around 4.2 region. And some of you may concern the exchange rate. Hey, if I invest in US, then there is possibility that I will lose in the exchange rate. So as a trader or investor in the US market, so as long as the return from the stock market is supersede, means is higher, return from the US market is higher than the exchange rate, then it will be worth it. So as long as the exchange rate is US, the return of your stock return, the investment return higher than the exchange rate, then it will be worth it already. And let's take a look on the past performance on US stock market returns. So these are the stock market return for 10 years. So which country are performing the best? from the chart here. Anyone want to type in the chat which country performed the best for the stock market over the 10 years, the past 10 years? Okay, so US stock market. So you can see that over the past, the Nasdaq 100 that track all the top 100 tech stock in US having a 295% return, and if we average out per year, it's around 29.5, and it followed by the S&P 500, which track the 500 stocks, 500 strongest stock in the US, and we have 154% return and 15.4% average return yearly. And number 3 will be the China market. SSE stand for Shanghai Stock Exchange. So it's around 10 years over 28% and 2.8% per year. And gold, where a lot of people think it will be a very good investment, it actually have a lower return, which is around 5% over 10 years and 0.5% per year. And the KLCI market is having a negative 8% and minus 0.8%. However, the Bursa KLCI has been on a sideways for some years, and there are quite a lot of over-penalized stocks or undervalued stocks that are still good. So it is still worth to monitor further. And if let's say you want to have a more predictable and consistent return in your stock investment portfolio, then we will recommend to invest in US stocks, because based on the past return, is this good? And also, there are more well-run company and more profitable company in the US market. So what company that are well-run in the US that you know of? You may type in the chat, what are the well-run company in the US that you know of? Anyone want to type any good companies you heard from US? Yes, Apple. Yeah, we have a lot of big brands, Apple, Microsoft, Amazon, all these big brands, they are actually listed in the US stock market. So you can see that all these profitable companies are actually in US. And other than that, some of you may have a concern. Hey, it's already dropped so much. It's already dropped so much. Whether it will be risky to buy US stock now, will it drop further? So if let's say you have some knowledge about investing or trading, you should have a exit point. Usually, investing strategy or a trading strategy, we will have a clear exit point. So from the chart here, you will exit around somewhere here already. And in fact, these are the best time for you to start monitor and time the entry back into the stock market when the reversal happen. So in fact, these are the good time for you to start monitor and wait for the reversal to happen and time your entry into the stock market. And these returns are solely just based on the stock market index. If let's say we are talking about individual stocks, it could be even higher. So for example, if we put in Microsoft individual stock, you can see that the stock outperformed the index by a lot. So it will be even higher return if you invest in individual stocks that are well run and having very good profitability and also having high growth. So this will be different result compared to the stock index. It could be even higher. And let's take a look on the economy cycle of the current economy. So how do we interpret this chart is, these are the cycle where it's the early recovery stage for an economy. So usually at this region, everything will be at high growth, everything will be rosy, everything will be nice. And at this sector will be the mid-recovery cycle, whereby the growth are start to slowing down or start to slowly declining, and the late stage will be the growth are shrinking, where we call it late stage of an economy cycle. And towards the region here will be the contraction cycle, where these people usually call it as recession. So from the chart here, we can see that in Q2 2022, China are already in recession. This is mainly due to their tight COVID policies. And we can see that US, UK, and also Eurozone still at the mid-economy growth stage. And as of Q3 2022, things start to change. Due to the prolonged high inflation, we can see that UK and Eurozone about to enter recession, and China is already in the recession cycle, and US also into the late economic growth cycle. And things further develop. During Q4 2022, we can see that Europe zone also enter recession already, and China still in recession. And at the same time, US start to going down into the late stage of an economy cycle. So we can see from the chart here, UK, Europe, and China is in recession, and US growth are declining. However, what we monitor in the economic data, we see that US employment still healthy, and US inflation, in fact, is coming down. And the rate hike, based on the latest central bank, US central bank news, which is the Fed news, that the rate hike could be going to be peak soon, around 0.6% to go. So what do you think is the probability of US entering a recession? You may type in the chat, what is the probability of US entering recession? High or low? Moderate? Very high, low? So to us, it still depends on the data, inflation data in Q1, Q2. Currently, the probability is not so high because we see that the employment is still healthy, the inflation is started to come down, and the rate hike is 0.6% to go. However, it still depends on the Q1 and Q2 data, whether the inflation is gradually coming down as per forecast, or still there are some spike there. So it depends on the data, and also depends on the coming central bank's decision, whether the interest rate hike is per what they forecast, or they will increase more aggressively due to the inflation not per expected data. So the Q1 and Q2 data, economic data, will be very crucial for the US economy, whether they will enter recession or they will walk out from recession. However, for the global economy to recover, then Europe and China need to walk out from recession. So these are the 6 factors that are affecting the stock market currently. So let's do a quick recap. So it all started when we have a high inflation. And why we have a high inflation is because at Q1 22, we have a war in Europe between Russia and Ukraine. And this caused the commodity price to went up, and also the wheat price to went up. And that is the two most important component. So we have energy and food price went up. That's why causing the high inflation. And if the inflation went higher, then too high, then the central bank need to increase the interest rate. And remember the relationship when we say increase interest rate, then the cost of borrowing will went up, and also the spending will become lower because people are less willing to spend and the demand are dropping. And this causes the companies to have revenue drop, have sales drop, and have earnings drop. And the side effect will be causing the stock market to go down if more and more listed companies are having an earnings drop. And at the same time, the interest rate hike also causing movement in the US dollars exchange rate. So when interest rate went up, the exchange rate will went up, and it will affect the export of the country. And with that, people are foreseeing the inflation is going up, and central bank are aggressively increase the interest rate. Then people are foreseeing a recession risk. And the stock market are always move 6 to 9 months ahead of the economy, hence causing the stock market to further correct and in a correction mode until now. And the supply chain constraints also causing the worldwide having a supply constraint and contributed to the inflation as well. And we have geopolitical tension that contribute to all the uncertainty in the stock market. So these are the 6 factors that are affecting the stock market currently. So after we take a look on all the factors, the events that are affecting the stock market, it looks gray and bleak, but we still have some positive news. Like the example, the 10-year return in the US stock market was good in the past, and if let's say things can recover, then it will be continue to go up. So let's take a look on what are the potential opportunity and risks ahead based on the market assessment. So what are the opportunities and risks here? So currently the valuation for the market is already near 10 years low, so which is already at very attractive valuation. However, if we foresee a recession is coming in first half of 2023, then it could be correct further, because if let's say recession coming, then company earnings may drop further. So now it's not the best time to buy yet, but it's the best time for you to start prepare, because it's the best time for you to start look out for all these great stocks, great companies that are over penalized or having a very good valuation and still having a very good sustainable growth. And next will be the travel restriction relief. So as we know, China are recently start to open up, start to loosening all their COVID policy. So we can see that the travel industry start to recover. Now China can travel, the tourists from China can travel to the world, and tourists from other countries can travel to China as well. So this will help the recovery on the economy of the country that rely on tourism or tourism industry or all these credit cards company. However, I would see this as neutral, because when things are opening up, people are traveling. At the same time, also we have recession in China and Europe. So when in a recession, people are less likely to spend money in travel. People will likely to cut their travel budget. And at the same time, it could be potentially causing a COVID spike as well, because the COVID case in China are currently quite high, still at a very high level. So other than that, we also have commodity price are peaking. This one will be a good news for the inflation, because if let's say the energy price start to peak, the food price start to peak, start to come down and flatten, then it will ease the inflation situations further. And also increase recession risk. So what does it mean by this? So because usually we will have a GDP forecast from the IMF, or we call it from the World Organization, an organization that forecasts all that monitoring the monetary policy everywhere, not monitoring, like forecast the economy. So usually they have a GDP forecast. And if let's say there are more companies that missing the earnings, then they will may further revision the forecast to the downside, because it may not factor in all these company earnings drop yet. So let me clear the. So next will be potential supply chain constraint relief. So with China opening up, with all the strict policies start to loosen, then factory can run back at full capacity. So factory likely to resume all their output to 100%. So this will provide more supplies of raw materials, all the electronic devices and all the goods to worldwide from China. So this potentially will help to relieve the supply chains constraint. And lastly will be the China stimulus. So there are news from Reuters that, in fact, Chinese leaders are now to signal more stimulus for 2023 as COVID outlooks cloud. These are the headline. So there are potentially, China will introduce more economy stimulus. Stimulus means they will stimulus the economy. So to encourage spending in the economy, loosen the policy rather than tightening the policy. So loosen policy means usually central bank want the borrowing cost to go down. They will decrease the interest rate or create more economy stimulus to boost the economy, encourage economy growth. So this likely China signal more stimulus for 2023, which is a good news for worldwide economy and will help China to recover from their recession. So with all this, let's take a look on the detail of each quadrant. So these are the crude oil forecasts. So for 2023, we are expecting the crude oil price to be stabilizing around 80 region, flattening around here. So this will help the inflation. This indicate that inflation could have already peaked, and it will help to help the inflation situation, help to bring down the inflation or stabilize the inflation. And next will be the consumer spending. So from here, we can see that the top three will be US, Europe, and also China. So China as a country will be number 2 because European Union is a region. So in order for the world economy to recover, China and European Union need to walk out from the recession, because the stock market will only recover when the consumer spending is back. And these are the global GDP forecasts. So we can see that from 2022 to 2023, there is a decline. So people are forecast in 2023, the GDP will decline. And what is GDP? So GDP stands for gross domestic product. Usually it used to track the economy growth, and the data usually come in quarterly, and it will in a percentage term. And this one will be on year-on-year basis compared to this year compared to past year. So in 2022 to 2023 transition, we can see that there are a decline in economy growth. So people are foreseeing a recession there. However, based on the forecast from 2023 to 2024, there are a potential recovery. So people are also forecasting there will be recovery in 2024. And like what I mentioned earlier on, stock market usually are 6 to 9 months ahead of the economy. So if we know that, and we know that recovery with that, we also know that the recovery will happen in 2024. So when do you think is the best time to buy? And when do you think will be the best time to learn about stock investing and also trading based on the information here? So to me, likelihood the recovery will be in second half of 2023, because if we see that the stock market 6 to 9 months ahead, then second half of 2023 will be a potential recovery. But it still depends on the Q1 and Q2 data. So let me launch a poll here. So how many of you, so hold on, so let me launch a poll. So how many of you think that, when do you think that stock market will be bottoming based on this data? Okay, I can see that majority of you are looking at Q2, Q3, all these are correct. So it still depends on the Q1 and Q2 data on the inflation and for the worldwide inflation, and also what are the central bank's decision. However, one of my question is, when is the best time to learn? So you may type in the chat whether when is the best time to learn for you. Yeah, I see a lot of you answer now, which is very good. So to find a good stock, in fact, it's the best time for you to learn now, so you can continue to train when we are still at Q1 and Q2, and when Q3 and 4 onwards, you can start to monitor whether the stock are making recovery, and you can capitalize on the recovery when the opportunity arises. So you also don't want to miss the great opportunities, because we are now at very good valuation, which I will support that data on the next few slides on the valuation part. Okay, so next. So these are the S&P 500 PE ratio. So what is PE ratio? It's price over earnings. So usually these parameters are used to measure the stock valuation, the stock price divided by the earnings. So these are a ratio. So usually people use it to measure the valuation of a stock. So these are the PE ratio of S&P 500, which indicates the 500 US stocks, the index that track 500 strong US stocks in the US market. And you can ignore all these lower PE prior to the year 2000. So why I say it can ignore the lower PE is because prior to the 2000, we have less tech stock, we have less tech stocks that are having high earnings and high growth. So companies in the past are more difficult to make money through the traditional industry. So they are less likely to have high earnings and high growth. However, from 2000 onwards, actually we are starting to have more and more tech stock that are having high growth and also high earnings and with very good profitability. So with the high growth and high earnings, it justifies the higher PE. So based on the past 10 years, you can see that the high is around here based on the past 10 years, and the low is around here. And the midpoint of the PE ratio will be at around 30 region. And currently we are at around 20, which indicates already very low valuation. The valuation is already very attractive and at the low side. So this in fact is a very good valuation now for the overall stock market. And in fact, the risks are quite worth to take, and the reward is quite high. And at the same time, some of you may question whether I can wait at the 15 level. So for the PE ratio to reach the 15 level, you need a very big crisis in order to bring the PE ratio down to 15 level. So at 20, I would say we are already at a very good valuation. And we also have a systematic way that we have a risk management method, which will be covered by, the framework will be covered by Terence later on, which will even further mitigate your risk. So if the valuation are so low, the risks are pretty low, and plus with a systematic, let's say you have a systematic way to handle the risk, actually it's very worth to take the risk already based on the current factors. However, you may need to wait further for the 1 or 2 more in economic indicators on the inflation and also central bank decision. But this slide will tell you that the valuation is already at very, very, very attractive level. And to support this valuation, so these are the statistics provided by BlackRock. So who is this BlackRock? So BlackRock is a world largest asset manager. So they have US $10 trillion of asset under their management.
All right, everyone. I think we got the problem with Zoom just now, so all of us got kicked out, and but
okay.
Yeah, we are all connecting back. All right,
Okay, so
let's continue.
I disconnected just now.
Yeah. I think everyone is disconnected. So suddenly, poof! It's as if Zoom got power outage. I think we're all good now. Lichai, you can continue.
Okay, so maybe I'll just repeat the BlackRock portion. So is it okay now?
But I can't see your.
Okay, let me share my screen again.
Yeah, share your screen, and
then
your video looks
everyone see my
frozen.
screen?
I can see your screen. Can you
Okay, let me restart my video. Okay. So is my video okay?
Yeah, your screen and video are okay.
All right, so let me continue. So just now, I think we dropped off on the BlackRock portion. So let me explain again. So from the valuation part we talked earlier, this was further support. So these are the statistics from BlackRock. So who are BlackRock? So BlackRock is the world largest asset manager with 10 trillion in asset under management as of 2022, as of January 2022. So how many of you think that with the asset manager of $10 trillion, their view or their opinion on stock market or their action in stock market will affect the stock market? You may type in the chat, yes or no. Yes, they can influence the market. So how we interpret this statistic from BlackRock? Okay, so from here, this statistic from this table tells us that when the S&P 500 PE ratio at 15 to 25, so now we are at 20. So the potential return, the potential average return, 1 year later will be at around 11%, 3 years later will be at around 37%, and 5 years later will be around 65%. So is this deal attractive compared to your, is this return attractive compared to your FD and others? Do you think that it's attractive, is an attractive return compared to the fixed deposit and so on, and other savings and so on? Do you think it's attractive? Yes, it's very attractive. So these are the opinion from their analysts, the analysts from BlackRock. This is their opinion. So for long-term mindset, for long-term investor, we have a decent entry point today due to the valuation here. However, we need to select all these over-penalized stock or stock with quality characteristic and stock with a resilience, can show a resiliency through a recession. So in order to find this stock, so you need a systematic way. So when do you think, so you need a systematic way. So do you think that the stock market will recover? So let me launch a poll. Do you think, hold on, so let me launch a poll. Okay, I think I cannot launch a poll now. Okay, it's okay. So how many of you think that with all the what we show you, like the valuation so low already, and with all the GDP forecast tell you that the GDP tell you that the economy going to recover in 2024. And I also tell you that stock market is 6 to 9 months ahead of the economy. So with that, you know that 2024 going to have an economy recovery. If let's say consumer spending, if let's say China and Europe start to walk out from recession and consumer spending start to resume, stock market will recover. And also at the same time, S&P 500 valuation at 10-year low, and it's at a very, very, very attractive valuation now. And plus, with the BlackRock statistic here, the BlackRock statistic here show you that there will be a potential double-digit return over the next 1 to 5 years, until the 65% is the maximum and 11% will be the minimum, the average, which is around there. So when do you think will be the best time to buy for you? And when do you think will be so you may type in the chat, when do you think will be the best time for you to buy for this? Based on this information. Okay, so I see some of you type now, but like I mentioned earlier, definitely not now yet. You may need to see the next 2 quarters earnings. So likely 2024 is a recovery, then 6 months means second half of 2023 to the late 2023, around that region. And also, when do you think will be the best time for you to learn and prepare? Okay, so when do you think will be the best time for you to start buying? Okay, so for this, since we are at early 2023, so we can do some planning, which okay, so hold on, let me change to my whiteboard. Never mind, I just draw here. So in fact, to me, the answer is the best time to learn is now, because let's take a look on how to plan this. So we are now at 2023, early stage of 2023, and these are 2024. So these are the throughout 2024. So let's say we be expecting a recovery in 2024, and we are now at Q1, and this one Q2, this one Q3, and yeah, Q4. Okay, 1, 2, 3, 4. Okay, so if let's say we are expecting the recovery will be somewhere here. Okay, so let me change the color. So best time then the stock market will be 6 to 9 months ahead, so it will be around Q2 onwards here. So for Q1 and Q2, sorry, Q3, this one it will be Q3. So let me redraw this one again. Okay, so let's draw a straight line here. Okay, so in fact it will be Q3 onwards, Q3 and 4 here. So this one, okay. So best time for you to learn, in fact, is, I would say, the first 2 quarters, which is now. So you can have another 3 months for you to practice. So let's say I have another shading here. So in fact, this will be the best time for you to practice and prepare all the great stocks you would like to invest in. And when the market starts to recover, you are already ready to capitalize. When the market is here, you are already ready. So this would be just an opinion from me. Just if let's say you are planning to capitalize in this upcoming stock market return, this will be a very ideal plan where you have time to train yourself, you have time to learn. Then after that, you have time to learn and gain some experience through paper trade and all this. And when the real recovery comes, you can capitalize on it and invest in the stock market and get the returns you desired. And these are the 6 opportunities and risks that are potentially to happen in 2023. So let's recap again. So number 1, the valuation is low now. And number 2, the travel restrictions are relieved. And although it's just temporary, but it's worth to monitor. And because of recession, I would say this was a neutral factor. But number 3 will be commodity price peaking. So when commodity price start to peak, it actually indicates that inflation could be stabilizing and already peaked as well. And with the increased recession risk, so this one I think is okay. This one, if let's say you will monitor Q1 and Q2, if inflation is stabilizing, then this will be less likely. And this one might have already reflected in the stock market because GDP forecast still have a bit downside, but the company earnings, you may need to monitor the Q1 and Q2. And potential supply chain relief, potential supply chain constraint relief. This one with the China opening up, it will further ease the supply issue and it will help the inflation as well. It can bring down the inflation. And lastly will be the China stimulus. So which if China are stimulus their economy, encourage economic growth over there, in fact, will be a very good news for the worldwide market. So let me launch a few polls here. Moderator, I think I'm not in the, I don't have the poll control. Can you launch a poll on when do you think the stock market will be bottom? And also another assessment on the poll.
Li Chai, I think already launched that just now. But yeah, let's do that again.
Yeah, let's do a quick check. Some quick assessment. Moderator.
Yep, it's already launched.
Okay.
So we have...
I think I have issue with my Zoom on the poll.
Okay. Yeah, so we have 30% of people responding. Yeah, let us know what you think. So majority, 50% of people think it's going to be Q2. And then about, well, the number is changing, right? Half the people think it's Q2, about 40% think it's Q3. And then have a few people think it's Q1 and Q4. So yep, most people think it's Q2. That's half of them. And then 40% think it's going to be Q3.
Yeah, so what most important is you may need to have a systematic way, and also at the same time have the knowledge to monitor the coming 2 quarters first, and also monitor the stock charts. This is what we have the systematic way. So let me proceed to the next slide. So these are the summary of here. So next, let's take a look on how to prepare ahead for 2023. So myself as a trader also, and since we are at early years, 2023, first few days of 2023, so we can actually plan our trade or strategies for the coming years, how to prepare ahead. So as a trader myself, I foresee that. So let me bring out my whiteboard. So as a trader myself, I foresee that. So these are maybe 2023. So sorry, let me clear and draw again. Okay, so as a trader myself, so I see that. So we are at this one 2024, this one at 2023. So Q1, Q2 could be volatile. So these are Q1, these are Q2. So this could be volatile, but we need to monitor the coming economic data and also the stock charts to confirm that. However, if let's say I foresee this one, then I will focus more on my intraday tradings during this period. Sorry, so let me change the color. So I'll focus on my intraday tradings during this period. And also this period, while I'm monitoring the economy data, and also at the same time, I prepare and monitor screen those stocks that I plan to invest. So we have different styles. So Terence later will cover on the difference of these different styles. So intraday trading, my means is that you don't hold the position overnight. So you has no overnight risk. You have no overnight risk, but it's more advanced technique. So it takes more time to learn. But at the same time also, I will start to screen those stocks that are over penalized or have resilience quality through recession. But I won't buy them yet for investment. I will wait. And when Q3 and Q4, so when it approaches Q3 and Q4, let's say these are Q3 and these are Q4. So I will start to monitor the stock charts of those stock I put in my watch list. So what I mean by watch list is like you shopping online, you have had to cut all these items you want to buy, but you never check out yet. So watch list is having this similar concept whereby you keep all the stock that you want to buy in a list. So I'll monitor them during Q3 and Q4 when the stock chart start to turn, then I will plan my entry into investment as well. So investment usually refer to longer term type of investing strategy. And intraday trading means trading. Trading means we're in and out fast and take profits. But when investing, then we are holding for long term, and we are using the company earnings to help us generate the returns through our investment. So this is how I will plan my 2023. And for this portion onwards, then we have a systematic way as well, which Terence is going to be covered. So we have this different framework that covers different trading styles. So with that, that is towards the end of my presentation. So from here, I will pass back to Terence on the trading styles and also the framework and so on. Okay, thank you.
Okay, thank you, Li Chai. I hope you have benefited from this session. And as Li Chai said, 2023 is the year that we expect the market to turn around. The economy may not turn around in 2023. We may have to wait for 2024 for that to happen. However, the market is 6 to 9 months ahead of the economy. That means we will start to see a rebound. We expect to see a rebound somewhere in the middle or the later part of this year. And you want to be ready. You want to be ready with a strategy that you can apply not only when the market rebound, but I think if you have a sustainable and a complete framework, you can even start to make profit even right now. All right. So there are 3 components when it comes to a strategy like that, a framework like that, where it's not only complete, but it is sustainable, right? So let me just share these 3 things with you, on the screen right now. So this is what we call a complete and sustainable framework. It has 3 important components: the S, the V, and the S, right? The S stands for systematic, right? You want a systematic process that make things repeatable. It's like a recipe that you can follow to produce the same taste, the same texture of a food. Okay, and what is a process? A process is basically a series of decisions that you need to make before you get the desired outcome, right? So in Beyond Insights, we have clearly documented all the important decisions that you need to make. There's a series of them that you need to make before you arrive at a decision whether to invest or to trade. And we call that a process map, right? So with any trading strategy that you're going to learn from Beyond Insights, there is a process map that you can follow and apply, right? So it's the most systematic program that you will find out there. And the second thing is being versatile. If you believe that you want to be versatile, that means you have the skill and ability to take care of profit, to take care of risk in any market condition, then the keyword here is versatility, and you're going to get that from Beyond Insights program as well. And the third most important thing is being safe, right? Safety. You want to be able to manage risk, because the key to success in any investing, in any business, in fact, it's about managing risk, right? It's not about avoiding risk, but do you have a solid, proven, time-tested methodology to manage risk and be safe, right? That's the third component of the SVS framework. So if you want to find out more about the SVS framework, just click on the link on the description below to join our next seminar, or you can type in the comment to arrange for a special session where we can share with you on a personal basis, in a group session, to elaborate more about what are the components of this SVS framework and what are the main things that you need to consider, you need to take care of, so that you can be a successful investor or trader and someone who is versatile, who can make profit in any market condition safely and systematically. All right, so check out the description or just comment below if you would like to arrange a session with us. See you soon.